Hello, and welcome to another session of Reflections on Investing by the Cornell Capital Group. Today we're going to talk about the 10-year Treasury bond, which may be the most important security in the market today. Just recently, billionaire investor and founder of Oaktree, Howard Marks, said that he thinks stock prices are reasonable, but only because the 10-year Treasury rate is so low. So let's start by looking at what's happened to the 10-year Treasury rate since April 1st of this year. If I bring up the iPad here, you can see that in early April, it was about 1.7%. And that was viewed as being reasonable in light of the booming economic activity and the risk of future inflation. But since then, it has begun a decline, a jagged decline, and it's now down about 1.2%. So let's unpack this and see what it means for the stock market. So what is the impact of the Treasury yield on the stock market? There are three things really you have to keep in mind. First, high prices. Low Treasury yields mean low discount rates, and low discount rates mean high prices. That's why Mr. Marks was saying that the current level of stock prices seems reasonable to him in light of the current level of interest rates, which remain extraordinarily low. But two, and this is one that many investors miss, high prices due to low discount rates. And we talked about this in an earlier Reflections where we asked, is the market overvalued? Mean lower future expected returns. So high prices, but lower future expected returns. And there's a third thing that many investors miss. Higher price sensitivity. When prices are very high because discount rates are low, relatively small changes in the discount rate, such as the drop we just looked at from 1.7 to 1.2%, can have a pronounced impact on prices. So the future of the market is intimately tied to the future of the Treasury bond rate. Well, if this Treasury bond rate is so important, then there's one more question we have to ask. What determines the Treasury yield? And there are basically four things. The first, and there's no particular order here, is government borrowing. The more the government borrows, the more bonds it has to sell, and that puts upward pressure on interest rates. So I'll put a little plus here. Now, offsetting that, the government actually does two things, because the government sells many of the bonds effectively to itself via Federal Reserve purchases. So number two, Fed purchases. The more the Fed buys, upward pressure on prices, downward pressure on interest rates. I'll put a little minus there. Three, economic activity. The stronger the economy, the greater the demand for funds, tends to put upward pressure on interest rates. So I'll put a plus here. And four, expected inflation. The higher expected inflation, the greater interest rates tend to be, because investors realize they're going to be repaid in depreciated dollars. Now, I'm going to put a question mark here because we really don't know what investors are expecting in the way of inflation. Back when rates were at 1.7 on the 10-year Treasury, this was attributed to fear of inflation. Now, the Fed has been saying repeatedly, and investors are perhaps believing, that this inflation is transitory and it will decline back to lower levels. That can explain the 1.2%. So, what do you want to take away from all this? The current low Treasury rates lead to higher stock prices, lower expected returns, and higher stock price sensitivity to changes in interest rates. What determines the Treasury rate? Government borrowing, Fed purchases, economic activity, and expected inflation. So, any investor worried about where the market is going should keep two things in mind. The first, you want to watch the 10-year Treasury rate. And second, you want to watch the things that influence the 10-year Treasury rate. Where do we stand at the Cornell Capital Group? Well, quite frankly, we think interest rates are too low. We can't understand why the 10-year Treasury is as low as 1.2%. But then we turn around and realize that the Treasury market is huge. It has thousands upon thousands of the most sophisticated investors in the world trading Treasury securities in amounts in the trillions. So if the market price is 1.2%, it's hard to say that that's wrong. We say it anyway, but we say it humbly because we realize the market may know more than us. This has been Reflections on Investing.